So, good afternoon, everyone. My name is Maurya Hanspal, and in this session, we will continue our previous sessions on the topic of wealth management. So, in the previous session, we have talked about some of the instruments which are good to invest into the market for the purpose of creation of the wealth. Now, what exactly did we talk about? We talked about the different securities to invest in any kind of the markets. We talked about the equity market. We talked about the bond markets. We talked about the commodities market, the forex market, and cryptocurrencies market. And also, we try to understand the various kinds of risk profile of an investor. That is, for example, if a person is willing to invest in the market, then he might not always invest into the equity market. He might not always invest into the bond market. He might not always invest into the crypto market or commodity market or forex market, as the name suggests. So, different kinds of persons would be investing into different types of market. A person who is a risk tolerant investor or a risk taking investor, that person might invest at least 80 to 85% into the equity market, the most risky market. A person who is a risk averse investor or a less risk taking investor, that person might invest approximately 80 to 85% or 75% into the bond market. Because when a person is investing into the bond market, his main aim is to have a fixed income. That is, he want to preserve his capital, or we can say the concept here is the capital preservation and having a fixed income. But when a person is a risk taking person or a risk tolerant person who is investing into the equity market, his main aim is the capital appreciation and growth. And somewhere in between, we have a risk neutral person that combines the strategy of both the equity component as well as the debt component. That is maybe like 50 is to 50 or like 1 is to 1 or 60 40 40 60 for the purpose of equity and debt. So this is one of the scenarios that can happen, right? So a risk neutral person, as we suggested, was a moderate investor. A risk taking person was an aggressive investor. A risk averse person was a conservative investor. So these two types of scenarios on the basis of the risk profile, we try to understand in very detail, right? So now it's the time to talk about the most important concept which people ignore in wealth management. And what is the most important concept is the retirement planning. It might sound weird for a large number of youngsters if a person talking about the retirement planning, because nowadays people who are the youngsters, not nowadays, in the previous time, the young people, they did not care about their retirement. They just cared about getting a job and getting their salaries, and just like buying things and luxuries, buying a home, buying a car, buying all the luxury phones, items, and taking care of the family needs. But this young generation has also realized the concept of retirement planning, because they have learned from their parents or fathers or forefathers that their corpus, which their parents or their grandparents had accumulated, that wasn't sufficient for their retirement, and they had to depend on their own children or even the grandchildren as well. So that is where the concept of retirement planning is very important, because the people who are not doing the retirement planning or plan for the purpose of retirement at a late age, be it late 40s or early 50s or late 50s, they cannot accumulate a sufficient corpus for the purpose of retirement. And that is why retirement planning has become a very essential component for the purpose of wealth management. That is how much wealth or how much corpus you must have at the time of retirement. And if you have sufficient corpus with you, you can also retire before as well, be it in your late 40s or early 50s as well. But you need to have a sufficient corpus with you. So now the question arises, how much corpus like should we have, or how much we should invest right now to have a sufficient corpus? Because when we do investing in the stock market or any of the market, be it the bond market, stock market, or any of the market, we want a certain rate of return. And obviously, we might be investing into the stock market for some varied reasons. We might be investing into the stock market for the purpose of buying a car at a later point of time, for the purpose of buying a house, or for the purpose of the child education or child marriage or child's marriage, or for any other purposes. Like we might be saving a corpus. But how to save it for retirement planning? So see, when a person goes for retirement planning, you have the solution-oriented schemes, as we talked about in the session of the mutual funds. You have a specific retirement solution plans, which aid in your retirement planning. There might be a portfolio which is for a risk neutral investor. Because if anyone is just investing into equity for the purpose of retirement, his portfolio might turn into negative at the time of retirement, and all the wealth that he has accumulated, it might get lost. Because equity markets are the risky markets for a risk tolerant investor or an aggressive investor. But when you are planning for the purpose of retirement, you need to have a sufficient corpus with you. So they might combine a strategy of a risk neutral investor, be it combining for both an equity and debt and being a moderate investor, or maybe for the bond market being a conservative investor. So these scenarios the person can go for. And all of the mutual fund companies and all of the banks, be it your HDFC Bank, ICICI Bank, Kotak, and any of these asset management companies are offering you solution-oriented retirement plans with different aspects, different time horizons, different investment amounts, and so on. Okay, so that is something you must know. So when we talk about retirement planning, you need to know that how much amount like you people must have. One rule that we talk about in retirement planning is the 4% retirement rule. So, what exactly is a 4% retirement rule? It basically says that you should have a corpus with you after the retirement. That if you are withdrawing like 4% of the annual corpus, like for example, if after the age of 60 years, you accumulate 100 rupees. Okay, like just an example for the sake of simplicity of the calculation, at the age of 60, you accumulate 100 rupees. So the 4% of 100 rupees is 4. Okay, so it basically says if you are withdrawing at least 4% of your wealth each year, if you are withdrawing at least 4% of your wealth each year, you must have a sufficient corpus with you to sustain it lifelong, at least up to the age you die. Age of dying, you people can take at least 85 to 90 years of age on being a conservative measure, because as your age increases, your expenses on like for functions, for traveling and all, they go down, and the expenses on your healthcare increases for an average Indian I'm talking about. Okay, it is very good if you are not prone to any of the diseases, be it in the age of 80 or 90s. It's completely fine and you should go for that. But talking about on an average basis, be it India or any of the countries, people suffer diseases, and the probability of the increase in diseases is much higher at the age from 50s or 60s or 70s, 80s, 90s. As the age increases, the probability of the diseases also increases. So that is something else. We are like not into the stuff of the doctorate and all, but particularly this 4% rule. This is also called the 4% withdrawal rule. This is your 4% withdrawal rule. So this 4% withdrawal rule in the concept of retirement planning says if you are withdrawing 4% of your wealth after retirement, you must have a sufficient corpus which is adequate enough for the purpose of your retirement, and you need not rely on anyone else for money. That is a 4% withdrawal rule. But many people argue, including me, that this 4% retirement rule was 100 years back or ages back. Is it really relevant in this phase in the present day generation as well? Because nowadays we have something called inflation, and inflation is ultimately eating away the money. So if we think that we want a certain amount of money, like for example, we want 100 rupees at the time of retirement, will that 100 rupees be sufficient for us? Because 100 rupees is the value right now. The value of that 100 rupees might transform into 200 rupees or maybe 5,000 rupees after 30 years from now. Like just imagine you are 30 years of age. Will that 100 rupees value of that 100 rupees remain the same? Because 30 years back, at the time of our parents and all, even the 1 rupee had a huge value. 30 to 40 years back, at the time of our parents' age, even the 1 rupee had a very high value, and the 1 rupee was equivalent to something we can call it as a luxury. A person who has like 1 rupee coins with him, that person was considered as one of the richest person into that locality. But nowadays, this 1 rupee is nothing, and even 100 rupees is nothing. So just imagine if this past 30 to 40 years, the value of this 1 rupee transformed to 100 rupees, and still this 100 rupees has no value. How much this 100 rupees can go up to after 30 years, and that no one tells you, and that you need to know, right? So this thing is very essential for you to know that this 100 rupees, it won't remain the 100 rupees after 10 years from now, 20 years from now, or 30 years from now. Okay, you need to include the aspect of inflation as well. Then why and where this 4% withdrawal rule will stand? Where will we have this 4% withdrawal rule? We cannot have it. This 4% withdrawal rule must be increased to 5%, 6%, 7%, 8% as per your portfolio, as per your assumptions, or as per your calculation that how much corpus you must have. So I personally believe this 4% rule was for the earlier generation, where the rate of inflation was very low and even just 1 rupee had a huge value. But now in this present day scenario where the 100 rupees also do not have enough value, even 1,000 rupees also they do not have even value. Every second person you ask, that person has at least 1,000 rupees with him. Even 10,000 rupees for a large number of people they have it. Okay, so that thing, if the value of the money is decreasing year by year because of inflation, because in the future, a sometime will come when the 1,000 rupees or 10,000 rupees would be like nothing for people and they would be just be considered as just 1 rupees. So that thing you have to take into consideration while planning your retirement. It is how much amount you have to invest right now to accumulate a sufficient corpus. If we are withdrawing a certain amount from that corpus after attaining the age of 60 years, which does not get beaten up or eaten up by inflation. Simply inflation ही खानी चाहिए. Okay. So I'll be coming back to the slide. Yeah. So it talks about the retirement planning. Yeah. Saving sufficient fund to live comfortably in retirement years. And what are the important steps you need to take into consideration for the purpose of retirement planning? Those are: need to estimate amount required after retirement. How much amount you would require after retirement? 1 lakh, 10 lakh, 1 crores, 10 crores, and that you need to look upon. And do not confuse the retirement planning with insurance. Insurance and term insurance, which I stress upon, is something that if you die, your family won't get a single penny. But retirement planning is something you are still alive and the term insurance will give you nothing. So you have to manage with your sufficient corpus that you have in the present scenario. Need to estimate the amount required after retirement. Involves calculating monthly earning, not how much money, because if you are earning like 20,000 rupees per month, then after retirement, at least you must have a sufficient amount of 20,000 rupees per month, or not even 20,000 rupees if your monthly salary is 50,000 rupees. And out of that 50,000 rupees, 30,000 rupees goes towards your expenses, or 20,000 rupees goes towards your expenses. So after retirement from the age of 60 years, you must have a corpus at least equivalent to your expenses amount when you were young. At least 20 to 30,000 rupees you must have. Then involves taking into account the rate of inflation, as I told you just 1 second back. To keep aside sufficient fund for contingencies. We do not know what the next thing can happen with you. It can be a wrong thing. It can be in terms of some medical emergency or some extraordinary expenses that you need to incur. So for that also you need to have a sufficient corpus. Timing of retirement, that is when do you want to retire? Some people retire at 60s and some go for like even 65 to 70s. Like whereas some retire in 50s, 40s, a wealthy person might retire in 30s also. Finding out how much money would be needed, how to create a regular income, understanding impact of inflation, rising healthcare cost, adequacy of accumulated retirement funds and retirement housing, like where you would live, and also all these things have to be taken into consideration. Now they talk about the golden rules of financial planning. Plan for more than you may need. Like for example, if you think that as per your monthly expenses, not your monthly salary, as per your monthly expenses, you require 20,000 rupees per month after retirement. So do not keep just 20,000 rupees with yourself. Keep at least 30 to 40,000 rupees with yourself, because emergencies and contingencies can come anytime. So keep the max to max amount. The 5% rule is nothing but the 4% withdrawal rule, as we talked about. Start start retirement planning early. The earlier you plan, the more corpus you would be able to have. Invest in real estate. You can have some reverse mortgage. We'll be talking about reverse mortgage. Mortgage. In short, it is nothing but if you do not have sufficient corpus, you can keep your own house at stake with the bank, and the bank would be giving you a monthly amount as per the value of your house. Okay, and you need not pay any of the installments. Once you die, either the house would be sold by the bank and the amount would be recovered, or either after your death, your legal heirs can pay off the amount in installments as a loan of the corpus that you used at the time of your retirement. Then monthly income scheme at post office is there. The mutual funds we talked about, you have pension funds, your provident funds, you have the old age savings schemes, which we call as the senior citizen savings schemes. You have investing in the senior living community. Now see how an average older 60 plus household spends its money. He spent 32.5% on housing, 11.3% on medical, food 15.4%, but like these things can be changed. Entertainment में वो कम time spend करेगा, but these things can change also. So for all these things, you must have a sufficient corpus. Now, what are the existing products which either have been made by the corporate, either the private or the public, or by the government? So certain products have been made by them which can help the people have a sufficient corpus for the purpose of their retirement. You have the civil pension scheme. Central and state government employees are eligible for the civil pension scheme. Part of the union and state budgets define benefits based on last drawn salary. New pension scheme for employees who joined after 2004. Then you have the employee pension scheme, which is as per the people who are working in a company, providing pension to members, widows, widowers, children, orphans, physically disabled members, dependent parents, nominee, managed by Employee Provident Fund organization, where like 12% is contributed by you, that is the employee, and 12% is contributed by the employer. And out of that 12%, 8 point around 8.3% goes towards your employee pension scheme, and 3.67% goes towards the employee provident scheme. Okay. Whereas the employer who is contributing 12%, he contributes additionally 1% extra, which is further divided into 0.5 for some administrative expenses and for the employer deposit linked insurance (EDLI). Then you have the new pension scheme for all the citizens, NPS slide for economically disadvantaged and not financially well-to-do. And they have given a certain amount, be it like 1,000, which is like $16.6 के नीचे अगर तुम्हारा income है, तो you can go for this. Then micro pension scheme is there by various microfinance institutions. This has been provided. Who were encouraged to save very small amounts and after fixed years start getting pension. And successful example is UTI and Seva Bank. So all these things are present. Then you have some annuity schemes. You have some national social assistance schemes. In annuity scheme, that you are depositing some amount every month, either in the beginning of the year or at the end of the year, so that you can have a sufficient corpus at the end. That is the annuity schemes. Then you have the National Social Assistance Program. You have the National Old Age Pension Scheme, National Widow Pension Scheme, National Disability Pension Scheme, National Family Benefit Scheme, and Annapurna. But Annapurna is basically for the subsidized food. Then we have the retirement saving for salaried employees. You have the compulsory employer and employer contribution, 12% or like 1.11%, and public provident fund is there, which I told you that 12% is being contributed by the employee and 12% by the employer. Okay, now they have given the pension plan benefits. Like you have a benefit because that money can be taken. So see, like whenever we go for pension now, after like when you retire at the age of 60 years, 60% of the amount you get as corpus in hand, which is tax free, and 40% is in terms of annuity, which is taxable. Whereas you also have the option of like premature redemption of the pension. In that case, you'll just get 20% of the amount as a corpus, and 80% would be as an annuity for the purpose of what? 80% would be for annuity, and it would be for the purpose for the taxable होगा वो, ठीक है? Then annuity benefits and death benefits, of course, you have like if someone dies, like you of course get the death benefits for that, because ultimately, if you die, your family would be getting that lump sum amount, like with guaranteed. But the thing is that if someone dies and you are getting like 50,000 pension per month, if the male is a working and female is non-working, and the female is getting no pension, if the male dies, then the pension gets reduced to half, or like 40 to 60%, the pension gets reduced. And that is something which really people talk about. Okay. Then surrender benefits are there. Then some tax benefits, and tax benefits are nothing but under section 80cc for the national pension scheme. You get tax deduction of 1,50,000 rupees under section 80cc, and additional reduction of 50,000 under section 80cc D Subsection 1B, additional reduction of 50,000 you are getting. So total 2 lakh की मिल जाती है. Then they have talked about the different types of annuities. Your immediate annuity is nothing कि जैसे ही आप retirement हो, you are getting the corpus. But deferred annuity, instead of getting it right now, you will get the annuity a period later. Then guaranteed period annuity for a particular period, be it 5 years or 10 years or 20 years, you get that annuity. Life annuity payment कि तुम lifelong, तुम कि जब तुम रिटायर भी हो गए तब भी तुम पर मंथ पेमेंट कर रहे हो ताकि तुमको वो सफिशिएंट कॉर्पस मिलता रहे. Okay. Then with cover pension plans have life cover component in the plan. Upon the death of the policy holder, a lump sum amount is paid to the beneficiary of the policy. However, the cover amount is not very high since a large part of the premium is paid towards growing the corpus rather than covering for risk. So see, you have the pension plans like in like one of the sessions I talked about ULIPs, the unit linked investment plan. So what basically happens in the unit linked investment plan, a certain proportion was going towards your cover, that is for your life insurance, like in case you die the amount would be given to your family, and the other part goes as a premium towards no, the first part goes towards a premium for your life cover and the other part goes towards your investments, right? So that is one thing. So these are some plans which are like combining the benefit of both your investment as well as the premium for the purpose of your life insurance. Try to like avoid these plans because यहाँ पे क्या होता है, the main focus is towards your corpus and they won't be focusing towards like your retirement plan and all these stuff. Okay, so try to avoid these steps. And then you have the contributory pension plans. You have the defined benefit pension plan and the defined contribution pension plan. So in a defined benefit pension plan, a fixed corpus is being decided कि जब तुम retire हो जाओगे तो like you will be getting a sufficient amount, right? But in a defined contribution pension plan, it is as per your contribution towards the company. Okay. Then the national pension scheme, like we have talked about the national pension scheme in the previous sessions. Like refer my sessions on fixed, on fixed deposits or like fixed income securities. I had talked about on the College Dekho platform, so that was available. And ULIPs also like I have talked about in detail in the sessions before. So that is one thing you must also look into. So see, like some of the points they say that we must allocate a fixed percentage of our income towards the retirement corpus. Fixed percentage of the income must be there towards the retirement corpus so that the corpus is not less for us. Then we must consider inflation and also invest in health insurance and specific plans. Okay. There are some basic things that you must take into consideration while taking a retirement. As I stressed all upon these points in the beginning of the sessions as well. That corpus must be sufficient for you. कम नहीं होना चाहिए. अगर तुम्हें लग रहा है कि 20,000 per month you have to spend on your expenses or any of the needs after retirement, save 50,000. Save 50,000 instead of 20, because contingencies and emergencies can come any time. And obviously you have to spend for the purpose of your healthcare as well. Tax implications, ATC ka has showed. If you want to know like more about the pension schemes and all, they have been discussed in the fixed deposit sessions. And there are sponsored. See these schemes and all, like we have talked about pension funds and all. That I just refer to the fixed income security session. All these points have been discussed like very extensively. And there I have talked about the pension scheme. I've talked about the provident fund, national savings certificates, Sukanya Samriddhi Yojana, tax saving bonds and tax free bonds. It may be like you have a difference. All these things have been talked about in very detail into those sessions. And one thing you should know, the pension is like regulated by your pension fund regulatory and development authority. So these things like you must know. Like whereas like when you are like investing into a pension scheme, they give you the option. They give you the 4 options, C, A, G, E. C is that you want to like invest into corporate debts. A is for the alternative investments. By alternative investments, I mean something except the traditional equity and bond plans. You can like invest into commodities or like real estate or hedge funds. Crypto तो भी नहीं होगा इसमें. Then you have the government securities, like which is D, and E is for the equity. And the government securities are the safest ones. And since they are the safest ones, they'll give you a lesser amount of return in the form of the interest rate. Equity are the risky ones. So higher the risk, हायर द रिटर्न भी होगा। तो 4 कैटेगरीज होती हैं, सी फॉर द कॉर्पोरेट डेट्स, के फॉर द ऑल्टरनेटिव इन्वेस्टमेंट्स, जी फॉर द गवर्नमेंट सिक्योरिटीज और वी आल्सो कॉल देम गिल्ड सिक्योरिटीज, and E is for the equity. Okay, and on the basis of that, they classify into the 3 categories. A moderate investor, which is like somewhere in between, which is a risk neutral investor, an aggressive investor, which is a risk taking investor, and a conservative investor, which is a risk intolerant or risk averse investor. And further, they give you the 2 choice. The one choice is the active choice, and the other choice is the auto choice. In the auto choice, they categorize like the organization or the government organization through which you're opening the pension account. They'll categorize you like on the basis of your age or risk appetite, on the basis of any of these criteria. But in an active choice, you can manually choose कि आपको कितने फंड में आपको कितना कहाँ इन्वेस्ट करना. And all this is for the tier 1 account, and all the benefits in the pensions or section 80C for like 1,50,000, 80CCD 1B ka subsection. Additionally, 50,000 is in tier 1 account only. The tier 2 account is also there in pension funds, which is basically as a mutual fund. But tier 2 में जो tier 2 का होता है account, वहाँ पे कोई benefit available नहीं है. ठीक है. So that's all for today. I'll be talking about some calculative or some calculations how to plan the corpus for retirement in the next session. That's all for today.